Good afternoon, folks. It's Dave Burrows, Chief Investment Strategist at Barometer Capital Management. And I want to thank you for jumping on the call today. I'm going to try and review sort of current market conditions, some of the things that have been going on over the past few days and a couple of weeks, and what that means for our portfolios. Hopefully, we'll cover off a broad range of items today, and certainly happy to answer questions. You can see that on your screen, there's a question and answer button. You could certainly type in a question there, and I'd be happy to take them, at the conclusion of the main part of the presentation. Just to kick off, we've had a bit of an up and down week. If we take the lens back and look at the big picture, we are in a structural bull market in stocks that kicked off in 2013 as we exceeded the highs from 2000. And certainly there have been a couple of pullbacks along the way, but we should assume that in a structural bull market like the bull market of the 80s and 90s or the bull market of the 50s and 60s, it's sort of 3 steps forward, 1 step back. And the pullbacks, when they come, can certainly be sharp and short, but they tend to resolve fairly quickly and market moves on. To put it in context, if we take the structural bull market that we're in currently, which kicked off in 2013, certainly it is less than half the length of the bull market in the 80s and 90s or the 50s and 60s. So it's not to say that it has to be similar to those two, but we did have quite an extensive bear market that started in 2000, didn't resolve until 2013. And so you would expect this to go on sort of for quite some time. The S&P globally was the first stock market to break out of its funk post the growth stock bull market of the 1990s. And, we continue to be in this channel, and we've been working our way higher since 2013, 3 notable corrections along the way, and we are sort of trading along the top end of the band. When we look at the NASDAQ also has obviously been very strong coming out of its bear market in 2016. And again, a couple of notable corrections along the way, certainly trading along the top of its band. When we talk about long-term themes, we talk a lot about stocks, but we've been talking a lot over the last 18 months about the process that we've been going through of bottoming a long-term cycle in falling interest rates. And the reason that that's so important is because what works during falling interest rates tends to be quite different than what works during rising long-term interest rates. And so we know that in the 1950s and 60s and early 70s, what worked very, very well was equities in general, but in particular, dividend growth stocks, which is quite different than the story we had sort of over the last 15, 20 years, where high dividend paying stocks that had low economic sensitivity tended to lead. Of course, there were times when they didn't, but that was sort of a background theme that allowed investors to build up a lot of holdings in the bond market because falling interest rates raised the value of bonds, and also buying assets that acted like bonds, and those would be things like utilities and real estate investment trusts and pipelines and so on. And certainly we participated along that way. But our view has been we've been going through a bottoming process in rates. And also at the same time, as rates have started to rise, I believe sort of a reflationary environment, we feel that we've been going through a bottoming in the long-term downward bear market in commodity prices. And of course, commodities tend to do better when demand picks up and when there's a stronger economic environment. Certainly it tends to do well when there's a lot of economic stimulus. We're seeing a lot of that. And we've had good evidence that that's the case. Now, here's a shorter term picture of the S&P 500. This is the corrective period we went through September and October, as the market really changed gears. And it really shifted the focus to parts of the S&P 500 that benefit in a stronger economic cycle. Of course, this is the period of time when the vaccine came to the front, and where it looked as though we might have a sort of a longer term solution for this. Excuse me. longer term solution for this pandemic. And in that period, we had a lot of the economically sensitive groups really take off. Excuse me. So let's take a look at that. Excuse me. Okay, so let's take a look at the S&P over that period of time. We've had, excuse me.
Sorry.
My apologies. So you had through November, December, January, and February, economically sensitive groups leading the market. I want to point out, it's interesting that in the outperformance of the S&P at year end, around quarter end, at the end of January and at the end of February, we had pullbacks in the market, and here we are coming into the end of March. Now, why might that be? Because the stock market has been so significantly outperforming the bond market. There are a large cohort of investors who have to keep a mix in their portfolios set that is static. In a lot of cases, it might be a 60% equities weight versus a 40% fixed income weight. And when they get to the end of a month or at the end of a quarter, and one has way outperformed the other, they sell the outperforming asset and buy the underperforming asset. Counterintuitive to us, but that is the way that there are a lot of investors work. It's called strategic asset allocation. And so what you can see is we've been seeing selling of equities around month end pretty regularly in the period where the S&P has so substantially been outperforming the bond market. Now, also you can notice this is the NASDAQ, and it has been in its channel since November, but through February and March, really quite substantially underperforming the S&P 500. Now, the reason for that, I think partially, is the fact that when you buy a company that has long-term secular growth, in a world where there is a lack of growth, investors have paid high earnings multiples for those companies, in effect, paying for many years worth of earnings. And when interest rates start to rise and they have to discount those future earnings back to the present to get the valuation they want to pay, rising interest rates mean that the multiple investors would be prepared to pay would be lower. And so we've seen money rotating away from those secular growth stocks into companies that are more cyclical or economically sensitive in the near term. And so that's something certainly we've been talking about over the last few weeks, and reducing our exposure pretty substantially to growth stocks in favor of some of the other sectors that we've been talking about. And this underperformance has been going on now about 4 weeks in price, and on a relative basis, the NASDAQ has been underperforming the S&P 500 really since late fall. So it raises one issue. When you get very strong outperformance, and this is NASDAQ performance versus the S&P in the late 1990s, when eventually value stocks started to perform well in the early 2000s, growth stocks underperformed for several years. That's not to say that we think that that is the case now, although I will say that growth stocks have been underperforming value stocks now for a few months, and it's certainly something to take account of. In our case, we have substantially lower exposure to growth stocks and substantially higher exposure to value or more cyclical companies. And, that's what we do. We try to recognize these change points and get positioned and be there to take advantage of it. So growth. Growth has lots of impacts. And one of the impacts it has is on long-term interest rates. Long-term interest rates have been falling pretty sharply since August. This is the yield. This is the price of a 30-year bond. But again, you'll notice at month ends, we've been seeing a little bit of buying in bonds here at year end, some buying in bonds at the end of February, and here we're getting buying in bonds at the end of March. Again, that reallocation process taking place. But it's pretty unmistakable. bond market is underperforming the stock market for the first time in many years. And there's a lot of money that's trapped in the bond market that may be forced slowly to reallocate to other types of assets. When we look at the significance of the sell-off in the bond market in the last year, what I can show you is that the sell-off has been more significant than any sell-off going back to the beginning of the bond bull market in 1981. So that tells us that this is probably something that is more significant than just a cyclical bounce in rates. We'll see. But I think that that is a clue that something more significant is changing. And of course, we believe we are into this reflationary environment. But to be clear, a sharply rising interest rate, if it happens in a hurry, rattles people and rattles investors and causes them to pull back on some of their exposures. And that may have happened over the last few weeks as well. But just to put it in context, if we were to look at all of the significant short-term run-ups in bond yields going back to 1965, the run-up that we have seen is more substantial or as substantial as any we have seen going back to the 60s, which may mean that in the short run, this is a composite of all of those periods, we could see a little bit of a back off in long-term rates, a little bit of moderation in the market. And I think market participants would certainly welcome that. So run up in 10-year bond yields, last few days, we've seen them back off a little bit. We'll see whether this sort of moderates and consolidates sideways for the next period of time. We know that when we did get this kind of bond yield run up, the forward returns for bonds were pretty muted, but they weren't really negative. So it may be we've seen sort of the majority of the very short-term move in 10-year yields. Okay, so what does well in a reflationary environment? The themes that we've been talking about for some time are pretty consistent. Banks and financial services do well in rising long-term interest rates. They also do well when the economy is setting up for an economic cycle, which of course I think we expect to have coming out of the virus. Certainly it's pulled back a little bit. When we get much moved away from the longer term smooth moving averages, we tend to correct, and that's what we've seen over the last week or so. But keep in mind, banks have been in a bear market since 2007. So that's a 14-year structural bear market. And this is still one of the least recommended sectors in the market and still significantly underowned by investors. Our strategy has been to focus in banks that have been able to grow during a difficult period. I've always had a view when an industry goes through a difficult period, the majority of participants will have a difficult time, and some companies will figure out how to flourish. And this chart looks at the companies that had the most significant revenue growth and loan growth. And the top performers were Silicon Valley Bancorp and First Republic, two of our most substantial holdings, whereas a lot of the other banks have had very little loan growth and in fact have tried to profit by cutting expenses. Tough to grow when you're just cutting expenses. We've focused more on the higher growth banks, and we think that we're going to get higher dividend growth out of this group to offset the impact of rising rates. Industrials continue to perform well, breaking out in October, November, pulled back a little bit in the last couple of days, nothing substantial. Consumer discretionary or companies that individuals choose to spend their hard-earned dollars at, doing quite well, expecting a little bit better economic activity. The home builders as one group, really has been a star performer over the last number of months. And that probably has to do with the fact that nobody wants to sell their existing homes. And there's a lot of demand for new homes. Materials have been another big winner, and certainly, again, pulling back over the last few days, and that certainly could go on for a bit. But this is a reflationary sector, and this includes, well, things like the agriculture sector, which has come out of a structural bear market, and other commodities like base metals and some of the precious metals and some of the lumber companies. But this is the RJI index, which is an equally weighted basket of commodities, meaning no one is worth more than the other. And you can see it's exited a 12-year bear market. Metals and mining stocks have been quite strong. And interestingly, uranium, after many years of underperforming, appears to be making a significant turn, and we have holdings in Cameco, which is one of the biggest producers of uranium. The Chinese are rolling out a number of new nuclear reactors. There's new technology, and there is actually bipartisan support for the nuclear energy in the U.S., nuclear energy industry in the U.S. Small companies have been outperforming since the fall, again, pulling back toward those moving averages over the last few days, and dividend growth stocks. So these themes are the themes that we've been focused in. Global equities, China's pulled back a little bit over the last few weeks. Japan performing particularly well. We talked about the fact that it's come out of a structural bear market. No sign that that is changing. And frankly, around the world, we're seeing strength. We're seeing good strength in our indicators in Europe. And interestingly, this is new orders in the Eurozone, and the flash PMI data literally almost off the charts after where we've been in the pandemic. So certainly we're seeing strength in economic activity in a number of different parts of the world. Now, we use our process to make our decisions, and we aren't trying to be everywhere. We are trying to make sure we focus in areas of leadership. These groups have kind of been leadership since October, November. We've had a very good run. We're always looking for signs of change. And of course, if things get sloppy, we're always prepared to play defense. In our process, in our top-down work, we are looking at all of the various investable universes of investments that we could make. And we're looking for parts of the market where if you took 100 securities within the group over time, more and more are participating in the rally. That's expanding breadth. And we know that's very healthy. When we see deterioration in breadth, it means we got to get a little bit more defensive. And it means we got to raise our stops, and we got to take a little bit of money off the table and hesitate to put money back to work so long as that deterioration takes place. Very often, breadth leads price action. In other words, we see the weakest securities within a group deteriorate first, and the stronger ones get impacted later. But this gives us forewarning. So that is all to say that we are seeing some changes in some of our indicators. And so I just want to visit some of those. Okay, so let's take a look at this. So from an indicator's perspective, we've seen some weakness over the last few days that we are paying attention to. Our breadth model for global equities, and this is measuring the percentage of stocks in the market that are in an upward trajectory, has started to weaken. So we've seen a little bit of weakness here, and some of our short-term indicators, the percent of stocks trading above their 50-day moving average, has started to weaken. We've also seen some weakness in the percentage of stocks with upward trajectory or momentum. So those are short-term issues. Now, every part of the world is different. Asia looks to continue to be strong. Europe continues to be strong. We've seen a little bit of weakness in the US and the NYSE. Whereas in January, 78% of stocks were participating in the rally. That number has come down to 66%. So that doesn't mean that it's a broad-based broken market. It means we're seeing some correction in certain parts of the market. And that means that we raise a little bit of cash. And it means that we get a little bit more defensive. It means that we tighten up the stop losses that we have. One of our key short-term indicators, the percent of stocks above the 50-day moving average, has started to fall, meaning some of the weaker securities have broken their 50-day moving average. The number of stocks with upward trajectory or momentum has started to wane. Only 36% of stocks in the NYSE currently have upward momentum, and the percent of stocks making new highs versus the ones making new lows has been weakening as well. So 3 of our short-term indicators have turned lower. One of our key long-term indicators for the NYSE has turned lower. And that doesn't mean it has to turn into a significant correction. What it means is we are consolidating. Markets had a great run since November. We are into quarter end, and we know there's this rebalancing taking place. In fact, there was about $300 billion worth of equities that needed to be sold coming into quarter end versus buying of bonds. And so we're seeing a little bounce in bonds, a little pullback in stocks. But so long as these indicators are the way they are, we'll be a little bit more careful. Europe remains strong. Asia remains strong. That's the Japanese bullish percent expanding. We know we've just come out of a bear market there. And interestingly, the Chinese indicator, after being weak for a few weeks, has turned higher. So they may be a little bit ahead of us. Of course, they've come out of the virus more quickly than North America. Now, groups that continue to look strong, the base metals group continues to make higher lows and higher highs, higher lows and higher highs. So that continues to be firm. And the energy group that has been so strong since November ran into some resistance recently, has pulled back over the last 7 or 8 days. Just to put that in perspective, this is the bear market that energy has been in since 2014. This is the bounce that we've seen through the fall. It may take a little bit of work to get through these levels. So all of that to say that we're just a little bit more cautious than we have been over the last little while. And we are just pulling in our horns a little bit. So let's go back to the main deck. Okay. So here we go. So long-winded way to get to the point. Short-term indicators looking a little weaker. Our long-term indicators a little bit weaker. But there are some mitigating factors. First of all, one of the things that we like to track is volatility and how the measure of volatility responds when markets correct. And you can see that over the last while, volatility has been fairly muted. The lower the number, the less amount of volatility. And in this few days of sloppiness in the market, there's been very little impact on volatility. And in fact, volatility is still elevated. This was, of course, the spike in volatility during the pandemic and each of the subsequent small corrections that we saw along the way. We've seen very little by way of a spike in volatility. And of course, it's not returned to the levels it was at through 2016, 17, 18, but it certainly is still at the low end of the band. Other factors that we're watching, certainly we're all watching the vaccines. The trajectory in the US has been much steeper than most of the rest of the world. They've really got a machine going. Europe has been slower and seeing some additional lockdowns. If we look around the world, Israel and the United Kingdom are leading. The United States is third, which bodes well for economic activity as we get later in the year. The EU and certainly Canada lagging in behind, and so they might be a little bit longer to get going. Financial conditions. So this measures the ease of financial conditions. So we always look at what the business activity is, and then we always look at the liquidity that is in the market. And easier financial conditions means there's lots of liquidity. So in the last few weeks, we've seen a little bit of tightening. That means that there's been a little bit of weakness in the stock market, a little bit of weakness in the bond market, but conditions continue to be very easy financially. We know that there is a ton of savings sitting on the sidelines that can still come into the market. And we know that there is a ton of fiscal and monetary stimulus, especially in the US, that's going to run through the economy over the next few months. When we look at earnings estimates looking forward, analysts have been steadily raising their estimates of what corporate earnings will be over the next 12 months. And we are sitting now at new highs for expectations for earnings over the next 12 months. To close off the earnings for the first quarter, the companies that Barometer owns on average beat the revenue estimate by 5.5% versus the S&P at about 3%. And the average company that we own beat the estimates that the analysts had by 29%. The S&P average company beat by 18%. So we're pleased with the individual business performance in the investments that we have. Look, the long view is that we think rates are headed higher. And if rates are headed higher like they were in the 50s and 60s, yield is going to become an important factor, and rising yield most importantly. At the end of the period of falling interest rates at the end of the 1940s, when bond yields started to move higher, stocks returned just about 15% a year until 1966 and outperformed bonds 5-1. So we have just exited a period where stocks and bonds had the same return over the last 20 years. And we believe we are entering a period much like the 50s and 60s where stocks will significantly outperform and commodities will significantly outperform. We're in the very early stages. So the portfolios are set up that way. We're set up for reflation. Financials continues to be our very largest weight. We think that the balance sheets are in good shape. We're headed into a stronger economic cycle. We expect them to be allowed to raise their dividends in the US and buy back shares, and we'll get capital growth and dividend growth from this cohort that is relatively underowned. We have a relatively newer weight in energy, which again is a reflationary theme. All of these are showing versus in red what the S&P 500 weighting is. So we're way overweight financials, we're overweight energy, we're overweight industrials, and we're overweight materials. When we get down to the bottom here, we are underweight the majority of assets that act like bonds. But we do have some short-term bonds currently and some cash. So the income mandate as of today is about 10% cash. And in our global portfolio, we took down any leverage and are in a much more defensive position. The reason that all this is important is that each of the periods where long-term bond yields rose, going back to 2000 when we started our income strategy, the income strategy, rather than go down with the bond market, rose against a weakened bond market. And so we had positive returns in periods where bond prices were falling. And that is the case currently. The income portfolio is ahead of the S&P on the year. It is outperforming the S&P since November, and that's during rising interest rates or falling bond prices. Last thing I'll leave you with. Last year was the first year of a new cyclical bull market, and it was a very good year. If you take other first years of cyclical bull markets and then look at what happened in the second year, well, they've been positive. So we don't know what this year will bring, but we think the financial conditions are supportive for equities and commodities through the course of the year, or a reflationary theme. We think that we probably could correct over the next few weeks, 5-6%, but we have our powder dry and we're in a good position to take advantage of whatever weakness could come in. And certainly we got a history of getting defensive when things get a little bit sloppy. And I think that we were quite quick in pulling in our horns over the last week. So let's see what comes next week. And certainly happy to answer any questions that you might have. But as we sit, we have a little bit of cash in portfolios. We're a little bit more defensive than we were a week ago. We are certainly much less focused on growth stocks and technology. You can see here that the technology weight is only 5.8% versus a S&P weight of 26%. And I think that we're in a good position going forward. So with that, let me just take a quick look at questions. Looks like we only have one question here. Let me see if I can get to it. Now, I don't seem to be able to get to it. Oh, here we go. Is it too late to buy copper? Would you prefer large cap Freeport or something smaller? So just quickly on that, certainly the copper stocks are pulling back a little bit. Let's just see if I can pull up the chart. Just see here. So this is Freeport McMoran, copper and gold. It's obviously had a very good lift into the fall, and then as the reflation trade really took off, it's really rallied. It's pulled into the moving averages a couple of times, which we're doing again right now. I would give it just a little bit of time to see whether we hold this support from back in the early part of March. But certainly we would be a buyer and be adding to these basic materials through this sort of consolidation. I would stick with one of the larger cap companies like Freeport. You might also look at like a First Quantum, which certainly also, can pull back a little bit more before it's done, but we're sort of into support here right now. These do move around. This whole group, though, we think will do well through the course of the year, and one that we would look to add to on weakness. Oh, we've got some more questions. How do wind and solar fit into the current picture? Well, that's a great question. And we have gone to the sidelines on solar recently. This is the solar ETF. And it started pulling back when the NASDAQ started pulling back, or high multiple stocks, growth stocks started pulling back, which took us to the sidelines. So we'll see whether it can consolidate in here and make a turn. At this point, we aren't putting any new positions on. A lot of the ESG companies got quite sort of over-owned by the end of January, and they're going through a correction. And we'll see when they make the turn. We're not going to try and guess when. We'll look to see them make a turn technically. What other questions do we have? What would be an impetus for gold moving higher from these levels? So the question is it a weaker US dollar? Well, certainly US dollar is one drag on gold currently, and it's been pushing up against this falling moving average. Certainly the higher bond yields have had an impact. But if we take a look at the very long-term picture, it still really looks like we are just consolidating. So gold made a great turn, made a new high, and has been consolidating that move. My guess is we're getting very close to seeing it make a turn. It feels like it's been consolidating for a while, October, November, but this is how chart patterns kind of shape up. Next question. Do we have a 3 to 5 year outlook for Cameco? Well, look, Cameco, let's see if I can put it up on the screen. Here's a long-term chart of Cameco. So stock topped out in and around $55 back in January of 2008. It's gone through a long sell-off and made a nice turn here, now challenging the longer-term moving averages at $16. I think that the longer-term picture is quite attractive. We really pulled the lens back a long way. These stocks tend to move in multi-year periods, and I think that we are in early stages. Is it possible Cameco could pull back to $13 or $14? Absolutely. But I think that the longer-term picture is substantially higher, and sort of the same for the whole uranium group. If we take a very long-term picture here of uranium, this is URA ETF. Again, a very long base and just having exited this bear market. So I think that this could be a group that's quite interesting. Certainly technologies changed dramatically in nuclear power, and supply demand is quite out of whack. So pricing could certainly go higher. Other questions? Somebody says we're still looking at XOP on the screen. So I apologize. Let's see if I can put the right picture up for you. There we go. So there's the uranium. There's the uranium longer term picture. This is the consolidation. This is Cameco. Same thing. Long term bear market. Bottoming process 2016, 17, 18, making a turn, breaking the downtrend line and into the moving averages. Certainly could consolidate here, but likely to work its way higher. Just see if there's any more questions here. Lots of questions today. Major drilling in Canadian Pacific. Okay, so CP, I think, looks great. you know that they're in a process of trying to purchase Kansas City Southern. That's a big deal. So this is the very long-term chart. Let's take it to a shorter-term chart. Pulled back on the announcement of that news. Very high volume day. Ultimately, if they can get this deal done, it's a really positive thing for CP. If you think about how the flow of trade works in North America, it's between Canada, the US, and Mexico. And Kansas City Southern would give it the piece into Mexico. North-south transit is growing more quickly than east-west transit. So that would be an attractive deal. And we're still getting more questions. That's great. Semiconductors, good question. Semiconductors have been a favorite group of ours for some time, and we have taken our exposure down dramatically over the last few weeks. Not to say we don't think that the outlook is good, but when we broke these lows here, going back in the early part of March, we substantially reduced our weights. So the companies that we have owned, Lam Research really has hung in pretty well. Applied Materials also hung in quite well. Taiwan Semi, that's certainly pulled back. And Advanced Micro Devices, that's certainly pulled back as well. There's a few other names. SiTime, which is a small cap semi, has pulled back into the moving averages. So look, they're correcting, and they're correcting with technology. If I take the XSD ETF, which is an equally weighted ETF that holds semiconductor companies, we had a first shot down, a rally that kind of failed at the trend line, and we're moving lower again. So I think that there's a little bit more work to do here. In our longer term breadth models, semiconductors are under a little bit of pressure, as is most of technology, which is why technology is only a 5% weight. The longer term picture, I think, is quite favorable. And so this is a group you could expect us to come back to. We're just sort of consolidating at the moving averages currently, but we'd like to see the breadth models turn up before we would put new money back to work. Let's see, are we missing any other questions? It looks like we have most of the questions. There was a question around copper and the fact that the Chinese have been stockpiling copper, and that is true. You get short-term dynamics like that. I would just say this, copper is a basic building block. And we think that it is going to be in a deficit of supply for several years, which is why the Chinese are building a holding. But certainly the group took off in August of last year. We're consolidating as it is right now, and the stocks are doing the same thing. If you look at the COPX ETF, we really blasted off here, left a gap on the chart. We come back and filled that gap. Does it need to do a little bit more work? Possibly. We aren't going to go straight higher. But again, when resource bull markets get going, they don't go for 3 months or 4 months. They go on a lot longer than that. So I think with that, we've covered off all of the questions. I hope that that the call today was useful. We'll see what the market looks like and the flows look like going through quarter end over the next week. Likely today was influenced by some of that rebalancing that we've talked about. And it may be that we have to consolidate for 2 or 3 weeks in a range. And we've got flexibility. We've got some cash. We're using our stops on individual positions where necessary. And then we'll see which groups turn up first. And my guess is that these reflationary groups will retake the lead in the market. And we'll see where we go over the rest of the year. So thanks very much for tuning in, everybody. And I look forward to seeing you in person at some point. And if you have any questions in between, certainly don't hesitate to get in touch with your counselor. If you are not with us and would be interested in talking to us about managing some money for you, certainly we would be happy to have those conversations. I'm happy to jump on the phone at any time. And if anybody's got questions specifically for me, I'm happy to jump on and respond whenever you need it. So thanks very much. And we look forward to doing this again next week. Have a great week.